Successful traders are aware of the risk they will take on each trade and the reward they will receive prior to executing a transaction. At its very core, the implications of risk and reward in trading are very simple. You objectively evaluate the amount of capital you wish to expose and evaluate the potential for reward against the risked capital. Ideally, a trade should only be executed when the anticipated gain or reward from the trade matches or exceeds the risk being taken. But it's not that simple. In today's video, I will share how I filter my trades based on risk and reward using price action so that you can protect and gradually increase your trading account. It is fairly common to see traders often complicating the perspective of risk and reward, leading to complex and often bad decision making in their trading. A primary reason has to do with the subjective nature of the reward element of the analysis. So let's discuss about each of them. First, let's address the risk factor in your trading. This is relatively easier and a rather objective task for a trader to determine the portion of capital to be risked on a trade. For most traders, it is usually a fixed percentage of their capital, for example 1% or 2% per trade. For some advanced traders who understand the varying probability of success for different trade setups, the risk factor could be defined in a range. For example, from 0.5% for an aggressive trade setup to 1% or 1.5% for a conservative higher probability trade. Obviously, there will be other factors to consider as well, like the frequency of trading, your individual risk appetite, the nature of trading, and access to capital, meaning how much money you have at your disposal for trading or investing. But no matter how many factors you put in this subject, the aspect of determining your risk per trade is usually a straightforward process that you are usually able to figure out with some basic trial and error. Now let's consider the perspective of reward factor, which is usually the bigger problem for most traders who struggle with risk and reward effectively in their trading. The reason the reward aspect gets tricky is because it's virtually impossible for a trader to determine beforehand what the outcome of the trade will be, hence making it technically impossible to arrive at an objective risk-to-reward ratio for a trade setup. An example would be entering the market with 1% risk and closing the trade at a 2% reward. But such methods are usually used by traders who don't understand market developments and price action as a core principle for their exit strategy. We are better than that, so we'll set a reward based on price. So how can a trader safely assume a particular risk-to-reward ratio on a trade? There are two simple techniques. A common method that is often successfully implemented by traders is using the first support or resistance area approach. As the name itself suggests, the first support or resistance area for a trade would be the closest level that the trader believes could possibly hold price, resulting in the worst case in a bounce of that level, threatening the viability of the trade idea. This approach calls for the trader to assume a conservative outcome for the trade, that is, the market will bounce from that area. Assuming that in a situation like this, you would want to take action to close out the trade, you could employ the distance from the entry to this first support or resistance area to arrive at an optimal risk-reward ratio for your trade. This example illustrates the first support or resistance area approach. Let's consider you want to sell at the close of this bearish pin bar candlestick pattern, with a stop loss above the high of the pin bar, and the first support or resistance area being used to evaluate a conservative reward value for the trade. This region represents the risk on the trade, and this one represents the potential reward. By comparing the areas based on the first support or resistance area approach, we see that the setup is yielding a near 1-to-1 risk-reward ratio. You can observe that the market actually pushed a little lower than the first support or resistance area, but that's irrelevant because the conservative exit occurred right at the first support or resistance area. Now, very important, the general problem that traders often face with this approach is that the first support or resistance area will usually not be far enough to result in a 1-to-1 or better risk-reward ratio. If you find yourself in a similar setup and the reward is lower than the risk, skip the trade. Now let's consider an alternate approach that does provide a bit more flexibility to the trader, and that is the major support or resistance area. For particular trades, a trader might be confident of a move farther away from the first support or resistance area, possibly because of the strength of the setup, which should ideally reflect in the risk-to-reward ratio. This approach calls for the trader to calculate the distance between the entry and the major support or resistance area that he anticipates price to be reacting at. The major support or resistance area could be the first support or resistance area, or an upcoming important area farther away past the minor support or resistance areas. So let's take an example to demonstrate this approach. In this case, the trader is now looking past the first support or resistance area towards the major support or resistance area, as shown here. Assuming the same setup and trading plan, you'll notice how the reward area is now noticeably larger than the risk area, thereby yielding a risk-to-reward ratio better than 1:1. The market did actually make it to the major support or resistance area, and in this case, the second approach would have worked better. The advantage here is a more realistic risk-to-reward ratio that accounts for a trader's own expectations of the outcome of the trade. However, on the flip side, it also requires sound judgment from the trader. For newer traders, this can be hard to achieve, as every trade taken is normally expected to perform very well, mainly as a result of emotions rather than concrete evidence driven from prevailing market conditions. For these traders, following such a strategy will often result in artificially attractive risk-to-reward ratios that are not very useful. So how do you find the risk-to-reward ratio that works for you? As a general recommendation, it would be wise for newer traders to begin with more conservative measures of risk-to-reward ratios, as determined by the first support or resistance area approach, and gradually, with experience and the resulting confidence, you could adopt the advanced major support or resistance area approach for a more realistic measure. While there's no holy grail to finding the perfect risk-to-reward ratio, a good place to start is to look at your win rate. Before you can expect your risk ratio to work for you, you must first confirm that you can win often enough to eventually hit that potential reward. For example, using a 1:1 risk ratio means that your potential profit is as big as your potential loss. This will only work out if you're right at least half the time historically. Bear in mind that a risk-to-reward ratio of 1:1 means nothing and depends on the expected trade outcomes. It is therefore more logical to be using a strategy that allows you to arrive at realistic numbers, even if it means having to pass on a trade setup due to a low risk to reward. A healthy mindset is to avoid being optimistic when you get into a trade. A common mistake many traders make is that they pick a very distant take-profit level or use a stop-loss that is too tight, just to create a larger risk-to-reward ratio. Of course, this leads to several problems and eliminates all of the potential benefits of the risk-to-reward ratio has. First, price can't reach the overly optimistic target levels and you give back profits. And secondly, price takes out the too conservative stop-loss and then continues to your initial profit level, but leaving you with nothing behind. In both cases, the trader has created the illusion of a potentially lucrative trade. Very often, traders use a large potential risk to reward to reason themselves into a trade they shouldn't be in, and they take the potential large payoff as an excuse to bend their trading rules. Before you are about to enter a trade, pause for a few moments and make sure that you have set your orders in a realistic way based on price action, and you are not violating your rules. Always remember that the reward ratio must be based on the market context and has to change on a trade-to-trade basis. Traders often try to use shortcuts and set fixed rules for their take-profit and stop-loss orders to come up with the same risk-to-reward ratio every time. However, the way you place your profit and stop orders has to change based on the chart context. If price is about to run into a support area, you should consider setting your profit target ahead of the level and reduce the likelihood of the price missing your target. If price is near a resistance level, you can set your stop at the other side to add another barrier between price and your stop. Always using the same amount of points for your stop can quickly lead to problems when you don't take support or resistance or other chart factors into context. Also, when you don't adjust your profit target based on the price chart in front of you, you can easily make the mistake of placing the order at strategic bad or hard to reach areas. Thus, instead of using a fixed risk-to-reward ratio with fixed rules for your stop and target, work with a risk-to-reward ratio threshold instead and adjust your orders based on the current price charts and the price context. As always, if you learned something new and found value, leave us a like to show support, subscribe to our channel, and hit the bell icon to stay notified when we upload new videos. Until next time.